Hello, everyone. My name is David, and you're with Continual Shift. Make shift happen, because in life, shift happens. We're focused on financial fitness, the whole idea of mental wellness, and healing and harmony, given some of the challenges that people are going through. Today on financial fitness, we'll review the portfolio we put together on March 25th, and we'll do a little update. We'll provide a little bit of guidance of what to do when you got positions and when the market's heading south, and coming up with my number one tip for May. And this comes from experience in the markets. As you know, that the retail numbers in the States right now are quite poor. Today we've dropped about 25% worse than expected, and we're going to continue to see volatility. Yet, is this volatility really honest? And I think one of the things that we're getting from a lot of the media in the States is that there is a lot of optimism. My experience in Thailand and in Indonesia in 1997 suggests that we have a lot further to go down if we actually really lose it. In both of those markets, the markets dropped 75%. In fact, the Indonesian market in 1996 had a $91 billion capitalization, and it went down 75% to $22 billion. The equivalent for the New York Stock Exchange would be from 25 trillion down to 6.7. Are you ready for that type of adjustment in the market? The Dow would go from 23,000 to 5,853. What would that do to your portfolio? Would you stay in the market? It's that type of preparation that I'm inviting you, not to create fear, yet to create awareness that this market could go down lower. And the invitation is to have some liquidity that if the market goes down. The other one is to be involved in dividend reinvestment trusts or DRIPs, so that if the market does go down, you'll be a regular buyer for the long term. And that's one of the things that I really want to enforce today or encourage. So let's take a look at how the portfolio did this past week. And I'm sharing this from a screen on Yahoo Finance. And I'm going to start at the bottom with Tesla, given the volatility with Elon Musk and his threats to pull his plant out of California, and also his opening the plant. We continue to have volatility. And it's one of the reasons why I'm involved with Elon, is I like to be aware of the markets, aware of some of the antics, yet I'm also fairly bullish in the medium to long term with Tesla, given their strength in electric, in battery, and also in their technology data play. So down a little bit today, yet pretty comfortable with that position. And we'll continue to perhaps buy or sell one share at a time, just to have a activity that goes, if the market drops in, like the last time he says something that it's overvalued, drops 10%, that's a good time to maybe buy some shares. Similarly, if it's really great news, sell a couple of shares. And that's called trading around a core position, something I really strongly encourage. The next one is AT&T. Again, the dividend right now for AT&T, let's just take a quick look. We got a 7.8% dividend now in AT&T. That's a juicy dividend. It's very unlikely to be cut. Can it be cut? Yes, yet not very likely to be cut. So I'm a fan of AT&T right now. If we go to Amazon right now, the core position is up since we bought it on March 25th. And again, bullish on Amazon. Their revenue numbers are phenomenal. Their profitability numbers are drawn down, given they've taken huge reserves. And in many ways, they are going to continue to underreport, given the incredible bankruptcies that are going to be occurring in the retail. So they don't want to be appearing so profitable. This is the window dressing that is very prevalent in reporting. It's one of the reasons why fundamental analysis can be inaccurate, is that companies regularly window dress their finances. In fact, you see some financials that are always revenue going up, profitability going up, steady. Well, that's window dressing, and it's something that multinationals, big corporations do on a regular basis. JP Morgan, down and volatile. Lots in the news about the banks, And the fact that some of them are perhaps going to be taken over right now, I like that volatility in the banks. I like the fact that we can have a range for JP Morgan right now between $80 and $100. It gives us an opportunity to trade around a position, to buy when it's down, to when bad news comes out, and then when the market recovers, to sell some shares. It's something that if you do like your core positions, I'm going to encourage you to do. I will continue to answer questions on it. It is a good medium to long-term strategy. To when you get to know your stocks, you'll see that they have quite a trading range every 52 weeks. And can you be actively trading while also long-term investing? Google, strong company, strong marketing, great balance sheet, continues to do well. I'm always waiting for Google to have a sell-off to pick up a couple of more shares, and it's going to be a core position for a long time. Apple, own it for almost 20 years, and Apple is, it's been fun in the last little while, picking some up at 290, selling it at 310. Continue to look at that one for the technology lead. They're and the investment lead, and so they're a leader in the industry. They're a leader in 5G, and a stock to hold and occasionally do some trades. And last but not least is American Barrick, which is part of my message for today. It's what type of insurance do you have? Can the markets in the States and Canada go down 10, 20, 30, 40% from here? The answer is yes. Yet the question is whether you're going to be forced to sell or not, or whether you're positioned to be able to handle that type of decrease. And if you are pessimistic or you're optimistic, it's to be realistic with your stock portfolio. And so a couple of opportunities here is to own a gold company like American Barrick, which is setting new highs today. And it is gone from 15.7 to $40 in the last 52 weeks. And today it's hovering around the $39 point. Is it got more room to go? My perspective is yes. So having a small stake in a gold company or the GLD, the ETF for gold, does make some sense. Similarly, if you're feeling there could be more risk, take a look at the VIX index. It's gone from 11 to 85 in the last 52 weeks, currently trading at 33, quite a bit down since March 23rd when we hit our lows. And definitely an indicator that if you think we're going to go south, to perhaps buy some insurance and pick up the VIX index. That would be two ways to play a downturn in the market. If you want to get into options, we'll talk about that in the future. Yet today, we're looking at mainly a long position and different ways to hedge your position. And so with that, that's the summary of our portfolio from March 25th. I would welcome any questions, some likes. I'm continuing to look at different types of analysis. Yet the one thing that I really want to encourage is to be present to your portfolio, be brave, yet also be wise. And so invest, look to trade, look to have stop losses, know why you're making your investments. Understand the company's dynamics, be curious, ask questions, engage. If anything today has been of some use, please hit the like, add a constructive comment or feedback as we're continually looking to make improvements to the site. Thank you so very much, and continue to invest profitably. This is Dave with Continual Shift. Make shift happen, because in life, as in the markets, shift does happen.